In this video, we will explain how to prepare both the single-step and multiple-step income statements. In a single-step statement, all data are classified into two categories. The first category is revenues, which include both operating and non-operating revenues, such as interest revenue and gain on the sale of equipment. The second category is expenses. This category includes cost of goods sold, operating expenses, income tax expense, and non-operating expenses such as interest expense and loss on the sale of equipment. To determine net income or loss, we simply subtract total expenses from total revenues. This statement is named single step because only one step, subtracting total expenses from total revenues, is required in determining net income or net loss. There are two primary reasons for using a single step form. A company does not realize any type of profit or income until total revenues exceed total expenses. So it makes sense to divide the statement into these two categories. The second reason is the form is simple and easy to read. The multiple-step income statement shows the steps in determining net income. Three important line items are gross profit, income from operations, and net income. As I just stated, the multiple-step income statement has three important line items: gross profit, income from operations, and net income. They are determined as follows. We subtract the cost of goods sold from net sales to determine gross profit. We then deduct operating expenses from gross profit to determine income from operations. And then lastly, we add or subtract the results of activities not related to operations to determine net income. Companies report income tax expense as a separate line item in the income statement before net income. In this example, income tax expense has been omitted, as well as income before income taxes. It's important to note the net income is the same under either a single-step or multiple-step income statement. The two income statements differ in the amount of detail displayed and the order presented. We will discuss each of the components of a multiple-step income statement in detail. The first line item is sales. The income statement for a merchandising company begins by presenting sales revenue. It then deducts the contra revenue accounts, so both sales returns and allowances and sales discounts from sales revenue to arrive at net sales. In this example, we start with sales revenue of $480,000 and subtract $20,000 to arrive at net sales of $460,000. We then deduct cost of goods sold from net sales to determine gross profit, which represents the merchandising profit of a company. It is not a measure of the overall profitability because operating expenses are not yet deducted. In this example, we subtract cost of goods sold of $316,000 from net sales of $460,000 to arrive at gross profit of $144,000. Gross profit is sometimes referred to as gross margin. We can also express a company's gross profit as a percentage called the gross profit rate. We simply divide the amount of gross profit by net sales. In this example, the gross profit rate is 31.3%, which is calculated by dividing $460,000 into $144,000. Operating expenses are the next component in measuring net income. They are the expenses incurred in the process of earning revenue. Operating expenses were $114,000. The company determines its income from operations by subtracting operating expenses from gross profit. Income from operations is $30,000. This is calculated by subtracting operating expenses of $114,000 from gross profit of $144,000. Non-operating activities are reported in the income statement after operating activities. These activities consist of various revenues, expenses, gains, and losses that are unrelated to the company's main line of operations. The distinction between operating and non-operating activities is critical to external users. These users view operating income as sustainable, whereas many non-operating activities are considered non-recurring. Non-operating activities are reported in the income statement as other revenues and gains, as well as other expenses and losses. This slide lists examples of each. The net amount resulting from other revenues and gains is added, and the net amount resulting from other expenses and losses is subtracted from income from operations to arrive at net income. In this example, we start with income from operations of $30,000, and we add $3,600 and subtract $2,000 to arrive at net income of $31,600. As stated earlier, companies often report income tax expense as a separate line item in the income statement right before net income. In this example, income tax expense has been omitted, as well as income before income taxes. Typically, the net amount resulting from other revenues and gains is added, and the net amount resulting from other expenses and losses is subtracted from income from operations to arrive at income before income taxes. This amount is then multiplied by the company's income tax rate to arrive at income tax expense. Income tax expense is subtracted from income before income taxes to arrive at net income.